The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Hi, I'm Ted Gioka. We're talking savings investments in your retirement. We just wanted to, we had a little bit of phone difficulty, but we're all good to go here. The Max Out Savings Show, we're talking about savings investments, your retirement, and where to go from here. We wanted to come on today just to go over really what's happening in the world. We continue to have just a lot of dislocations with the war, with the Iran war. We're dealing with the credit crisis with the private equity. And we have to understand, how do you deal with this with your retirement? Where do you go from here? We wanted to just kind of give you some ideas, some sort of updates of what some of our thinking is on what's happening, where we're going. As far as the war goes, it just, this thing, it's been, quote, this is going to be over in a couple weeks situation. It's clearly not going as expected. Iran learned a lot of lessons from when we've attacked them in the past. They learned a lot of lessons from the Iraq War. And so we're dealing with a much tougher adversary. They're willing to open the straits, but they want the United States they want to be able to collect tolls so they control the Persian Gulf, and then they want us to pay for reparations. Now, a couple thoughts there. They might be pulling basically. They've studied Donald Trump's negotiating tactics, and his taco and everything else is negotiating tactics. And for some reason, it's just people lose their mind when he asks for the moon and accepts a lower number. Anyone that knows anything about negotiations, and he's probably one of the best in the world at it. I mean, I like a different way of negotiating, but that's one way to do it. And so they're studying those tactics. And so we're at a real impasse right now. And so here we are today. We've lost some planes. But more importantly, there's an enormous number of heavy equipment moving out of the United States as we speak over to the Middle East. And the huge transport planes are just moving. They're all up in the air right now. And that's just not a real good situation. The question is, we could probably if we let Iran control the Persian Gulf, they control Saudi Arabia, they control Kuwait, they control United Arab Emirates, Dubai, they're going to control the entire Arab world, even though the Iranians are not Arabs, they're Persians. And so it'll go down as one of the biggest defeats in American history. And so, the situation is we're kind of in for a penny, in for a pound at this juncture on this war. And so I think we need to understand that. I think the initial hope was Trump was going to take out the top leadership and then bomb them for a week or so, and then say, hey, look, as long as you give us the nuclear weapons, we'll just go on our way and move forward. And one of the more disturbing things about this whole thing is the word peace isn't being used anywhere. I mean, the strategy, appears to be, we'll stop them for 5 years and we'll go back over again. And in my lifetime, you tried to come up with some type of peace. I don't think we ever really had one with Korea, North Korea, but we had peace with Germany. We had peace with Japan. We had peace with Vietnam. We had peace with a lot of countries around the world. And somehow you have to have peace. I think that's something that's been lost in the world today. I mean, both sides have to agree to live peacefully together, and I'm not seeing any of that at all. And now with the ramp up, I mean, at some point in time, maybe the United States is going to have to install bases in parts of Iran. Once they figure out that's what we're going to do, they'll finally back off. And so this is where we are. It's not a good situation, and now our concern is more retirement. We manage retirement money, trust, the long-term money at Max Out Savings Advisors. So in this environment, what do? Do you dump everything? And it's been my experience, it rarely is a good idea to dump everything. You have to sit there and diversify and come up with into different areas and protect yourself, have higher levels of cash. But if you're looking at the market, okay, so I just, kind of rattled through what the situation was. Well, the market was up last week. I mean, market was up 3.6% last week. If you look at the Dow, it was up 3%. The Nasdaq was up 4.4%. So it's not like there's panic in the streets at all, and it's almost. And if you look at the market was really, for the month of March, the market was off about 5%, a little over 5%. We basically have stepped up into a war that has really not gone well. And it's leading to massive disruption of commodity prices. We're going to cover that later in the show. And for the market to be up, that's a huge win. If that's the case, you're in the biggest bull market in our lifetime, because that just means that there's just so much money wanting to come into this market that they don't care about the Middle East. And I don't think that's the case. If you look at the market on Friday, one of the things that jumped out is that oil prices were up. West Texas crude was up about 11.4%. They've been holding it right under $100, and it's actually trading kind of where the contract, depending on the contracts that you're dealing with the March contract. For Brent, they show a June contract on CNBC, and you're like, oh wow, things aren't that bad. No, that's like 3 months into the future. They're not showing you the higher prices because they don't want you to go, oh my God, what do you mean oil is up to 109 or on Brent, or was trading in 115 earlier in the week, and so they show you the FAR contract 3 months into the future where it's lower, but West Texas jumped up too, and so because what's happening is we're having to haul. The tankers are lining up along the Gulf Coast, picking up crude oil, diesel fuel, jet fuel. They're moving it to Japan, to Taiwan, to Asia, to help our allies over there, India, for liquefied petroleum gas, to try to help them out because they've lost their key supplies to the Persian Gulf and they're in trouble. So we're having to, so we can go, well, look, hey, we don't really import that much. This doesn't affect. Well, the problem is that oil has to come out of the United. It's like, look, we've lost 20% of the LNG in the world. We've lost a certain percentage it's a lesser percentage of the oil. Where's that all going to come from? The only people that have really excess oil and gas is the United States. We really don't have excess, but we have, we really weren't cut off that much, and so we're having to move our energy distillates in oil and gas out of the country. Over there now. So the West Texas jumped up about 11%, but the stock market, it finished up the day on Friday after the West Texas jumping up 11%. It finished up, and Brent was a little different. It went up as well, not as much, up about effectively even on the day, and it just defies logic. Almost everybody on planet Earth knows the U.S. stock market is being manipulated. That's not the place you want to be in, is the problem. That works for a week, a couple days, but at some point, that's not a good place to be. And so given what's happened over the weekend and given the movement Again, we're right near they tried to bring it right up against the 100-day, the 200-day moving average, and try to hold it up. But I think you've got to continue to have a defensive posture in place in this market, which is just higher levels of cash. We pulled some of our hedges off, right near the end of the week. We made money on them for clients because it just looked like it was sort of going up. It almost put them back on Friday, but we've got a lot of cash and stuff, and so we really felt like we were in a reasonably good place. But this just doesn't look good right now, and so because we have the problem is the dislocations from this war are spreading around the world, and we're going to cover some of those after this quick break and some other ideas of what to do, where to go, and different things like that. How to protect yourself and how to understand and how to deal with this. And we were talking, some real interesting comments came out of Morgan Stanley, actually one of their people, about generational wealth, which I thought was fascinating, and I'm going to be covering that as well. We'll tell you what, we'll take a quick break. We'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day, which is Monday. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
This is the Max Out Savings Minute with Ted Gioka. Ted's on the line. Ted, well, the president's got some things going on with Iran. Is he backing off, or what is he doing with that and the price of oil?
Everyone's not sure what's happening in the Middle East. It's jet fuel, it's gasoline, diesel's produced over there. It's all types of chemicals, fertilizers. I think about 40% of some of the fertilizers come from over there. It's helium. About 25-30% of the world's helium comes from over there, which is critical to semiconductors. And so this is causing a lot of issues. Now we're trying to get some type of peace plan in place. Pakistan's working on it. Rumors that China is trying to work on it now. The Asians are being hit pretty hard by this. There's gas lines pipelines around Asia now and price controls. So hopefully we'll see some resolution.
Well, Ted, we'll be discussing that, and I imagine a lot of other things this Saturday morning at 10 o'clock on the Max Out Savings Show with Ted Gioka on AM 1070 and FM 103.3. The Answer. Ted, thank you, sir. You have a wonderful day.
You too. Thanks, Chuck.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're looking, actually, I was listening to the commercial, thought that was part of the earlier show. It actually just going over some of the stuff about the percentage of things of commodities coming out of the Persian Gulf. The problem we're running into with this war is not that it's the fact that there's a war, but the fact that if this war was happening in Africa or somewhere, or in Greenland, or Australia, for instance, it wouldn't make a whole lot of difference. But the problem is it's being fought in the Middle East, which the Middle East is the most energy intensive area in the world. They have enormous energy. It's cheap. Natural gas is cheap, which means they make everything from gasoline to diesel fuel, to fertilizer, to helium, all these urea, all these things that come off of natural gas and oil. And so the prices of those are going up around the world because we've lost all these percentages of these products coming out of the Persian Gulf. Fertilizer's up 29%, gasoline's up 42%, sulfur's up 43%. Diesel's up 44%. Urea, which is a type of fertilizer, is up 48%. West Texas crude's up 51%. Brent's up 58%. European natural gas is up 71%. And heating oil's up 77%. I don't even have jet fuel on that list, but that is skyrocketed as well. Well, the things I just mentioned cover almost every aspect of production in the world in some shape, form, or fashion. If it's steel making, it's the cost of energy. Yeah, it just goes down the list. And so this is inflationary. If this would have gone on for a week or two, it would have been no big deal. But here we are stretching out into the fifth week, and it's going to be how many more weeks? And so, where does this stop? And this is the problem that we're dealing with. So in that world, you have to be somewhat more cautious. In almost any war, look, nobody thought World War II was going to last 5 years. I think you could have polled everybody, that knew anything in Europe and in the United States to how long they thought the war would. I don't think anybody would have said 5 years, but it did. I don't think this is going to last 5 years, but it's going on longer than expected. So in that world, you want to have, I'm not sure what's going to happen, higher levels of cash. And, you can sell everything, but the problem is you sell everything, and then the next day the Iranians give up and the markets skyrocket up, and then what do? So you try to figure out, hey, what's going to go up when this is over? How can I diversify? My portfolio. I was just looking at some stuff on annual returns. They compared the tech sector with the energy sector, and they looked at the Sharpe ratios, which is just what type of return you're getting for risk, and that's a simplified explanation. But if you put the two together, the Sharpe ratio went up because in the returns, your risk-adjusted returns really went up over the last 6 years because when one went down, another one went up, and it kind of balanced them out, and really you didn't get the drawdowns in the portfolio. And so you want to spread your risk in this type of market. Cash is one way to dampen portfolio risk. If you have higher levels of cash and the market falls, it's not going to go down as much. More importantly, when it goes down, you go, wow, that looks like a really good buy. You have something to buy it with. It doesn't do you a whole lot of good if your portfolio is 100% invested in the stock market and the market plunges 20-25%, and you see a really great value and you like to buy something, you got to sell something that's down. And so that's one way to do it. The other one, as we talked about, is having that energy, having that tech, having the precious metal, some of these things that operate differently in the environment, overseas stocks, so it balances out and stabilizes the portfolio. Bonds, that typically most investment for retirement are really 60% stock, 40% bonds. There's a reason for that because the risk-adjusted return is pretty good. It's not quite what it was for stocks, but you don't have a 53%, actually 56% decline in the S&P 500 like you did in 2008 with your portfolio. And so bonds right now, we just rattled off a big list of products that were going up in price that could be inflationary. So shorter term bonds, the 2-year Treasury. Let me look at that real quick. This is just one example. This is something that we like, and there it is right there. Okay, the 2-year Treasury, when the war started, was yielding 3.4%. Well, right now, it was up around 4. It's right now it's about 3.8, 3.79. It's still not bad. You lock in close to a 4% return over 2 years. If we go into a recession, rates are going to fall. You're locked in. If inflation goes up, maybe you get a little better return in the second year. But honestly, it's a heck of a lot better than owning a 5 or 6 or a 10-year bond. And so it gives you some protection there. Again, with retirement, we're managing money for 20, 25, 30 years into the future. And so the trick is to be around during that time frame. And the trick is to get good returns in that time frame and try and to minimize any massive drawdown that just does huge damage to your portfolio. And that's something that the research really shows that the bigger danger is to retirement is really the earlier years of your retirement from a drawdown, not the later years. It's kind of almost counterintuitive. People, it used to be the thinking the older you got, the more conservative you got with your portfolio. But what they're really kind of understanding is you got to maintain a certain level of risk tolerance throughout your portfolio, because because if you get that 56% decline in the S&P 500, 2008, that becomes real difficult to recover from because you're pulling money off. Once you start pulling money off of your retirement plan, it's usually 1 or 2 years near the bottom, which you're really damaging your portfolio, and so. Those are, some of the things to think about. So you want to manage that risk, and in these type of times, it's important to continue to manage that risk, and so that's something to think about. Like I said, there's just a number of ways to do it. Overall, I mean, it's hard with energy up here because once the war's over, energy prices are going to fall. But I think one of the things I think we're going to have to take a real look at with this war. I think this war fundamentally changed. I don't think the last war with Iran, if you can call it that whatever they called the war was, where they bombed the uranium sites and some of these. I think this war has the potential to be really to change the world in so many ways. I mean, I don't think anybody, for all the talk of the Persian Gulf being closed down, look, this is the first time the Persian Gulf's ever been shut down. And understand. And so this has completely disrupted the world's economy. So it's put a risk factor so it ends tomorrow morning. People are still going, what just happened? I can't have that risk again. And so it's going to make it's not the safest place people now understand over there. They're going to have to diversify their energy risk. I mean, President Trump's right. I mean, people are going to do business with us because they're going to want to spread their risk around. It also, look, if we give in to the Iranians and the Iranians win and they get to charge tolls going up and down the Straits of Hormuz, every country in the world is going to concede they can stand up to the United States. And so you can't let Iran really win in any big way in this thing because all our allies in the region except Israel are going to turn against us and go to China or somewhere else because we're not going to be viewed as reliable. Really, on so many levels, if you look at it, I mean, if the United States doesn't have a plan to produce 1 million drones, we're going to be behind the curve in 5 years. I mean, drone technology and missile technology, the amount of those, it's going to be massive productions of those. I mean, we're in a stock that's involved in that, because I don't see how you stop this now. And in so many ways, the Ukraine-Russia war is the gift that just keeps giving to everybody out there, and then it's morphed into this over here. And so you have to understand the world has fundamentally changed. AI, look what just happened to AI. AI was blowing and going. They're building out these all over the place. We had cheap energy. We had gas at oil at $60 a barrel. Natural gas was cheap, unlimited energy. They're building these all over the place. Well, we just had one of the AI centers in, I think, United Emirates. I think it was an Amazon facility, was blown up. And so we're going to have to now plan if some of our systems get taken out over here. Energy costs are clearly going up. What did I just say about oil? And gas is going up some too. Oil is up 51%. Brent is up 58%. Well, and that's going to push up the price of electricity. Well, these things are the biggest electricity hogs in the United States. And so it's changing the dynamics of that. There's going to be shortages. We talked about the prices of stuff going. Aluminum. We didn't even mention aluminum. One of the UAE's aluminum facility think it's going to be out at best a year. Aluminum is huge use in data centers, copper. So they're going to have trouble getting this stuff to the AI centers. So some of these AI centers aren't going to be built. So I want you to understand that this thing is really, we're seeing these are big changes that we're witnessing before our own eyes right now. And it's not going back to business as usual like these other little wars in the past, even the Iraq war. I mean, it was over pretty quickly and nothing really ever changed. And I think the Persian Gulf was, people were a little nervous for a while on that, but it shut down. They didn't have the damage with the exception to Kuwait. We got the damage extending from Kuwait all the way up to United Arab Emirates to Oman right now, inside all of them. And so in that world, you have to pull back a little bit, have a risk plan in place, something we have just talked continuously about on the show, to really deal with these type of things. And understand that we don't really know what's going to happen. I think this show stays on top of things as good as anybody. I mean, when the Ukraine war, we pivoted immediately, said it was going to be inflationary, said this was going to be big changes. We said it was very bullish for gold. As soon as the U.S. and the Europeans froze the Russians' treasury reserves, we said gold was going up and exploded. We're good at dealing with these very tough issues like this. And so I want you to understand that there's a lot of changes coming, we believe. And so we want to kind of continue to watch this and see what's going to happen. Now, it's just, honestly, I think I could talk for 2 hours on this subject, but the other thing is, another thing we wanted to just touch base on today too is I was happened to be watching CNBC. We kind of keep it running in the office in the background, and every once in a while I'll walk by it and see something. And there was, I even might have been in the car listening, but someone from Morgan Stanley, they were talking about private equity, and private equity is a huge problem out there, as we've discussed. We're going to talk a little bit. There's more private equity funds have been gated. Blue Owl, they were actually talking about Blue Owl and it was the Bloomberg show, and Tom Keene was going, wow, if this war in Iraq wasn't going on, this would be all we were talking about, because Blue Owl, of their $36 billion private debt fund, it was private debt, and 22% of the people wanted out. And then they have a Blue Owl private debt tech fund, and 41% of the people would be out. I mean, these are shocking numbers. And almost every single private debt fund is gating their investors. Typically, when you invest in these things, they go, look, Mr. Jones, this is private equity. It's a little risky, but since it's hard to get it now, if you can only take out 5% per quarter, which is 20% a year. So if you need funds to live off of, you get that. And so people go, okay, well, this works, and they get sold a bill of goods how these things beat the markets and stuff. Well, they're using leverage, number one, and they're buying the junkiest credit out there, number two. Well, actually, number one, they're buying the junkiest, and then they're using leverage. So these things aren't the most solid investments. But as the situation keeps getting worse, almost every single major company out there is now gating their investors, which means in private equity, everybody is trying to get out. Now, in fairness, I mean, I can actually see, if someone comes to me and goes, hey, look, in the next 6 months, we can go buy a bunch of private debt cheaply because the market's collapsed. We're contrarians and we're value investors. We might take a look at it. I mean, we use crisis on Wall Street to our advantage to make money, but that's kind of an aside. So what these things are all being gated with the private credit. This is a big part of small business and private equity, which is taking over companies. They're going to have trouble borrowing money now. And so this is going to mean a couple things. It's going to slow down the economy credit-wise. Because keep in mind, all the banks are going, hey, Ed, did you see what happened? If I'm sitting on the credit committee at the bank, we're sitting down like, Ted, did you see what's happened to private credit? I'm like, yeah, what's going on? Well, I'm not sure. We need to take a look at all our stuff to make sure our companies are in good shape, because they could be hit by the private credit. Maybe they're borrowing. We need to tighten up our credit standards. So they're tightening up credit standards on private equity and banking for small businesses now. So this is going to slow down the economy. This is a big deal. This is very analogous to the Drexel Burnham blow up of junk bonds back in the 1990s, and it eventually starts hitting the economy, just like the mortgage debacle in 2007 brought the failure of an investment bank on Wall Street, as we predicted in 2007. We were one of the first people out there in the Max Out Savings Report and the Max Out Savings Show, and I remember distinctly because I thought I'd get pulled off the air after I said it. So this is just another area of uncertainty that's coming down the pike. And so, tell you what, we're coming up here on a break. And I want to expand upon this. And so some real interesting things about Morgan Stanley's remark about generational wealth. And I really want to cover that. It's really fascinating. We disagree with what they were saying, and I think it's one of the big problems out there with that big money is really facing. We're going to discuss that after this quick break, right after this on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day, which is Monday. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement. This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com. I'm Ted Gioka, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Gioka can come in, and he can help. Go to maxoutsavings.com and schedule some time with Ted. That's maxoutsavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3. The Answer.
I'm Ted Gioka, and I approve this message.
Max Out Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or maxoutsavings.com. Remember, you can hear the Max Out Savings program right here, Saturdays at 10 a.m. on AM 1070 and FM 103.3. The Answer.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. I wanted to cover, I actually mentioned one of our sponsors, Rangoni Alto Gin. It's one of the finest organic botanical gins in the world. It's produced up in the Italian Alps, all natural organic botanicals. They've been brewing these type of drinks for thousands of years. If you go back and study, the Roman times, and they did a lot of these type of things. They didn't have the fancy things they have today, and so they got very good at using botanicals and different things to produce just incredibly high quality drinks. It's called Rangoni Alto Gin, and look for the kingfisher bird on the label. You can get it at Specs or Total Wine or other good stores out there. And actually, it's in some of the best restaurants in town as well. Rangoni Alto Gin. The talking about the private debt and people investing in it. These typically are invested in pools. You're more locked into the private debt pools, and you can take out 5% a year. And the Morgan Stanley person made the comment that most people should have, 5 or 10% of that. I forgot exactly. But for generational wealth, maybe she might have said 50, and I forgot the exact. For generational wealth, 35% or more could be in alternative funds, alternative investments, which are private equity, private debt, those type of different funds. And this is, I just couldn't believe she said it. This is a racket on Wall Street. They get these newly rich people, and they go to they go to these brokerage firms, and they get them into stocks and bonds, and then it's like, hey, look, you're super wealthy, you should be doing alternative investments. And the head of recently Harvard University last year they had a lot of protests, a lot of attacks on Jewish students, and just an enormous amount of anti-Semitism. Well, Harvard didn't do anything about it, and some of the other universities, which was appalling. And so it came time that their donors, a lot of them were giving them big chunks of money each year, and they go like, yeah, hey Bob, yeah, it's time for your donation. Like, you're kidding me, right? Are you seeing what they're doing to Jewish students on campus? You people did nothing. You're getting nothing. And so they had to borrow. They needed more money. So they had to go to their endowment. And they have a $40 billion endowment. Now, you would think this would be no problem. But they had so much money in these, quote, alternative investments, Harvard had to go out and borrow money. And a couple thoughts on generational wealth. I've been around it. I know it pretty well. In the smart generational wealth, they're not out there loading the boat on private debt funds that are buying most private debt is rated under junk bonds. It's at the low end of junk. And then levering up the position to make even more money on the deal, because when the recession hits or the financial crisis, that stuff blows up. And so you can have great numbers for 5 years, and then you could get wiped out. The smart generational wealth, they own property. Well, they own stocks. Good quality stocks. They own bonds. They own treasuries. They own municipal bonds. They're not taking their municipal bond or their corporate bond portfolio and then borrowing against it and levering up to get even more income. They're not doing that. Okay, they're buying ranches. They're buying property. They're buying an apartment building. They're buying another house. Sometimes they'll take a little debt on the property or the house, but they might borrow 30%, put down 50 or 60 or 70%, borrow a little bit, but they're always cautious because they're wealthy. They don't need even more. They'd like to become even more wealthy, but what they really their number one goal is not to lose their money, and it's almost like a scam on Wall Street, these big Wall Street brokerage firms selling these people on these private debt and private equity things that are around. Same thing with some of the real estate stuff. I mean, we have clients come in all the time that have real estate deals that they've been sold to by other advisors or brokerage firms. They don't work. I think I've purchased about 15 properties in my life. I think I've made money on almost every single one of them, and some of them enormous amounts of money. A couple things. Sometimes at first they didn't seem like good investments, and then some of the things we made 10 times. We sold the properties in some cases 10 times what we bought them for. Not 10 times our money. But we held them long term. We got high quality property. We got in front of whatever growth trend was out there, and we sat around and waited. Generational wealth can do that. It's the classic example is you drive through Tanglewood or River Oaks. You see a lot there. I've mentioned this in the show. You're like, why would anybody leave a lot? That's because they have a whole bunch of money. They just don't want to lose it. They know a lot is always. They can always sell their lot. It's always valuable, and if they ever need money coming in, it's there. And so, but it's not risky. Most of those people, I very much doubt, have a huge note on the lot at the bank. And so how you want to look at it is, let's say you're not generational wealth worth $100 million or $1 billion, but you can do the same thing yourself. You can buy. We're talking to a client yesterday on this. You can purchase a rental house or something. It's the same type of deal. Again, 15 houses, or 15 not houses, just complexes, built, all types of stuff. We've involved in purchase. They've all made money in a lot, and then I see these deals, and none of them seem to work. And so understand, because you're paying big fees, and these people are flipping positions, and it's just sometimes you can do some of the real estate yourself, but so. If you're retired, if you're wealthy and have a lot of money, you want to think like a generational person, but not like a generational person at the Morgan Stanley or whatever. But you want to think like the generational person, that's the person sitting there living in River Oaks, that they diversify their assets in different sectors. They don't want to lose the, they're not here to make 15% a year every year for 10 years. They're here to have a solid return and not get wiped out. There's a big difference. And because they're set for life. If you've got, several $1 million in your IRA, you're set for life at retirement pretty much. You got to watch your money, or 10 million or whatever. You just don't want to lose the money. And so, and this is something, there's just been way too much on Wall Street pushing these private deals, private equity, private debt, real estate, all that type of stuff, where in many cases the people didn't know what they're doing, particularly private equity and private debt. And so these things are all kind of blowing up out there. And this is going to take time to work through. Financial crises never are quick. As we said, I think in I want to say July of 2007, we said the perfect storm in the home markets with debt there. And then it started getting worse and worse and worse. And in November, we said, look, we were doing research on the brokerages and investment banks, and we were shocked on how much debt their balance sheets had gone up. We do a lot of debt analysis because we're value investors. We're like, oh my God, these guys are going down. And so we wrote about it. And so these things it's the same thing with private debt. And so understand this is a big issue that's going to continue out there. And again, you want to be cautious. You want to stay away from it. And see, in 3 or 4 months, like I said, we're such value guys and such contrarians. We would even be willing to maybe look at it in the future. But right now, there's a lot of people really stuck in this, and everybody out there is trying to get out of it, and that's not a good situation. So again, there's always money to be made. Our clients are up year to date, and so I want you to understand there's always places to make money, but it's not that you need to be frightened in a cave or something, but you do have to kind of manage your money and prudently think through. You're going to make investments, and they'll go down, I promise you. But you want to do is you just want to make sure eventually they go up, or if they don't come up, there's other things that offset it. And I think that's kind of the thing. I think, again, we'll see what happens Monday. But it's positive because, and the thing is not to watch the war, but watch the commodities and watch the after effects. At the present time, there's lines for gas in Thailand, the Philippines, Ethiopia, Australia, Indonesia. The Prime Minister of Japan is asking all citizens to conserve fuel. They're looking at ways to maybe work from home. This is for the Asians. This is a really big deal. And so I think we want to kind of continue to watch this and see where it all goes. But right now it's not going in the best direction. And so that you want to kind of stick with the caution. So a couple of things in the show, like I said, one talked about is when you think generational wealth, if you're wealthy, you want to spread your assets around, and you want to understand what you need for liquidity and what you don't. Even if you just buy a house or something, you might need some liquidity from time to time. And by the way, one of the good things about those houses, ranches, or other things that they're big wealthy, if they ever have problems in the future, they can always sell off that asset. They have control of it. They're not stuck in a fund. And that's the other reason with it. So when you're wealthy, when you've saved a lot of money, when you've built up wealth, you're separate. Think like a J.P. Morgan, think like a DuPont, because that is generational wealth as well. But think like those people. Don't think like a bunch of Wall Streeters, speculating all over the place and endangering your future because you just don't want to lose your funds. So a couple things. We're going to be writing about this in the Max Out Savings Report. We're going to try to keep you up to date with a lot of these big issues. I think put it down a little more concisely in the Max Out Savings Report sometime. We try to bring very complex issues and we try to make them simple. and take them down to where most people would understand it, how to deal with retirement, understand. It's the Max Out Savings Report. And it's free. Just go to the website, maxoutsavings.com. If you need some help with your retirement, we're here in Houston, Texas. We manage retirement funds. We manage trust, money for people that are conservative people that want to grow their money, and that we use a lot of kind of complex things. I think more so than most people to try to put together portfolios that will grow over time and kind of navigate through these really tough times. Because it doesn't do any good if you're blowing and going in the stock market, making money, and then all of a sudden the market crashes and you give it all back. The trick is you want to make money consistently, because when it crashes, you don't want to be panicking and dumping everything at the bottom of the market. And that's why it's so important to have that diversified risk portfolio. But you can, if you want, you can request an appointment with me. Just go to the website, get our phone number or email. Drop me a line or email. I'll set up an appointment with you here in Houston, and we'll go over your financial situation. Like I said, we're value investors in the stock and bond market. But think like a wealthy person. Protect your assets. Remember, save aggressively and then invest conservatively. That, my friends, is the key to wealth over the long term. Save aggressively, invest conservatively. If you do that, you're not going to have anything to worry about. Well, I hope everyone has a great weekend and a happy Easter. Remember, Christ is risen. And we'll radio savings show. But until then, if you get a chance, go to our website, maxoutsavings.com. It's maxoutsavings.com, and sign up for that free report or help. I'd like to help you out. We can meet with you here in Houston, Texas. Just request an appointment. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
I'm Ted Gioka, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues. And that's where Ted Gioka can come in, and he can help. Go to maxoutsavings.com and schedule some time with Ted. That's maxoutsavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3. The Answer.